Most people who feel financially stretched assume the problem is personal. They think they're disorganized, undisciplined, impulsive. They look at their income, look at their bank balance, and quietly conclude, I should be better at this. Let's slow this down. If you earn a solid income and still feel pressure every month, that feeling isn't automatically a character flaw. Sometimes it's math. And sometimes the math is concentrated in one place: housing. Housing is the largest expense in most people's lives. Not groceries, not vacations, not subscriptions. Housing. And when the largest expense in your life grows too large relative to your income, everything else begins to feel tight, even if nothing else is extreme. This is where the conversation usually goes wrong. People zoom in on small spending. Coffee, streaming services, eating out. But if your housing is consuming a massive share of your take-home pay, optimizing the edges won't change the center. You can trim around the margins, but the weight is still there. If this feels familiar, not dramatic, just quietly heavy, press like so more people see this conversation. A lot of financially responsible people are dealing with this, and almost no one talks about it clearly. Here's the first thing to understand. Housing doesn't just cost what the mortgage or rent says. It costs what the property taxes say, what the insurance says, what maintenance says, what utilities say when square footage increases, what furnishing says when rooms multiply. The bigger the space, the more expensive the ecosystem around it becomes. And because housing is framed as responsible, people tolerate strain here that they would never tolerate elsewhere. If your car payment made you anxious every month, you'd reconsider it. If your housing payment makes you anxious, you tell yourself that's normal, that's adulthood, that's just what it takes. But anxiety that repeats every 30 days is information. High income doesn't fix this automatically. That's another misunderstanding. If your income rises and your housing scales up with it, the pressure doesn't disappear. It stabilizes at a higher level. You earn more, but you commit more. Your lifestyle expands to absorb the raise. This is where the math matters. Imagine someone earning $120,000 a year, taking home perhaps $7,000 a month after taxes, depending on location and benefits. If housing costs $3,500 to $4,000 all in, over half of their take-home income is already spoken for, before food, before transportation, before investing, before living. That doesn't leave margin, it leaves coordination. And coordination requires everything to go right. The problem with thin margin isn't that it fails immediately, it's that it fails under stress. A job loss, a medical issue, a market downturn, a surprise repair. When housing is large, any disruption feels amplified. This is why some people earning six figures feel more fragile than people earning less but living below their means. The difference isn't intelligence, it's structural exposure. Let's go one layer deeper. Housing locks in time. A 30-year mortgage is not just a payment, it's a long-term obligation tied to your ability to earn consistently. If your payment is modest relative to income, that obligation feels stable. If it's stretched, it feels like pressure that follows you into every career decision. You hesitate to take risks, you delay starting something new, you stay in roles longer than you should, not because you lack courage, but because the payment must be met. That's not a moral issue, that's a cash flow issue. And here's something people rarely calculate: opportunity cost. When a large percentage of your income goes toward housing, that money isn't available to invest elsewhere. It isn't building diversified assets. It isn't compounding in other systems. It's concentrated in one place. Real estate can build wealth, but it builds wealth most efficiently when it doesn't consume your flexibility. When it consumes your flexibility, it limits your ability to invest consistently in other areas. This isn't good or bad, it's a trade-off. The issue is that many people don't consciously choose the trade-off. They drift into it. They buy what they're approved for. They stretch slightly because it'll grow into it. They assume future raises will make it comfortable. Sometimes that works. Sometimes timing disagrees.
Interest rates change, markets shift, job industries evolve, and when housing was purchased at the edge of comfort, small external changes create internal stress. If you're watching this and thinking, this feels uncomfortably accurate, you're not alone. I'd genuinely like to know in the comments what surprised you most about your housing costs after you moved in. Not to complain, just to understand the full picture. Because what often shocks people isn't the mortgage, it's everything around it. Repairs don't schedule themselves conveniently. Insurance premiums rise quietly. Property taxes adjust. Even renters face annual increases that compound over time. Housing has a way of escalating slowly, while income grows unevenly. And here's the psychological layer. When you move into a larger or nicer space, your expectations adjust, the standard resets. You maintain it differently, you decorate differently, you host differently. The house subtly changes your spending behavior. No one announces this shift, it just happens. So when you look at your bank account and feel disappointed, you assume it's because you're overspending in obvious ways. But often the structural base shifted upward and everything else followed. Let's simplify this. If housing consumes a high percentage of your take-home pay, your financial life will feel tighter than your income suggests. That's not failure, that's math. And math doesn't respond to guilt, it responds to structure. This is why two households earning the same amount can experience completely different levels of stress. One keeps housing below a comfortable threshold and builds margin. The other stretches to maximize space and builds obligation. Over 10 years, the outcomes can diverge dramatically, not because one person was smarter, but because one person preserved flexibility. Flexibility is underrated. It doesn't impress people, it doesn't photograph well, but it protects you. When housing is manageable, you invest consistently. You absorb shocks calmly. You make career decisions based on growth, not survival. You sleep better. When housing is oversized, every other decision tightens. Now, this doesn't mean everyone should sell their home tomorrow. That would be reactive, and urgency is usually the most expensive part of any decision. What it does mean is that clarity matters. Look at your numbers, calmly, not emotionally. What percentage of your take-home pay goes to housing in total? All of it. Mortgage or rent, taxes, insurance, maintenance, HOA fees, utilities that scale with size. If that number is high, your stress may be rational. You're not bad with money. You may simply be carrying too much fixed cost relative to income. And once you see that clearly, your future decisions change. The next move, the next upgrade, the next approval amount, you start asking different questions. Not, can I qualify, but what does this payment remove from my life? Not, will this appreciate, but will this preserve my margin? That shift alone can change your financial trajectory more than cutting small expenses ever will. If you want more conversations like this, where we slow big decisions down and look at the math without panic, consider subscribing. That's what this channel is about. Clarity over hype, structure over emotion. At the end of the day, financial stability isn't about proving you can handle the largest possible payment. It's about designing a life where your largest payment doesn't quietly control you. Housing should support your life. It shouldn't consume it. And if you've been feeling stretched, behind, or quietly anxious despite earning well, let this land clearly. You're not bad with money. You may just need more margin.